Thanks for tuning in to Tax Strategy Digest, where we explore the fascinating world of finance. Join us as we dive into the stories, insights, and experiences of experts, thought leaders, and everyday people who are making a difference in this field. Through engaging conversations and thought provoking discussions, we'll take a deep dive into the latest research, trends, and innovations shaping finance. So sit back, relax, and get ready to learn something new on this journey here with us. Welcome to this episode of Tax Strategy Digest. Today, our guest is Carlos Sera. Carlos is a registered investment advisor representative and the founder and managing principal of Sera Capital Management. His firm, Sera Capital, is a fee-only fiduciary that focuses on tax-efficient exit planning for real estate investors and entrepreneurs. Their two mottos are when you want out, call us in, and we help landlords retire tax efficiently. Carlos, thanks so much for joining me on this episode today.
Thank you, Paul. How are you? We have a third motto now. Since I work with my son and my other son and my nephew, our third motto has become, let our family help your family.
I love it.
So that's our third motto. And we'll keep coming up with more as the years go by.
That's perfect. That's perfect. Well, Carlos, tell us your story. How'd you get to where you are today? Have your family all in your business? Let's talk about it.
Well, the family in the business, that no one knows how that happens. Okay, it just kind of happens. I think that my love of what I do kind of rubbed off, and they kind of said, maybe I should do that. And so it wasn't planned. It was not planned. I'm 65. I have been managing money for people since I was 22 years old. So this is all I've ever done. But we did not get into the exit planning business till about 10 years ago. And as coincidental as my kids getting into the business, things are not as planned as people may think. But we had a client, a 77-year-old widow who had a $2.5 million piece of real estate. And if she sold it, she was going to pay $800,000 in taxes. And I just couldn't let her do that because the standard advisory solution is sell the property, pay the $800,000 in taxes, take the 1.7, give it to me to manage at 1% at Schwab, and I'll pay you a 4% a year distribution rate or $68,000 a year. Then you pay $8,000 in taxes, you can spend 60. So that's when we started really digging deep. And we discovered the 1031. We had no idea what it even was. It took us about 6 months to a year to really do the full due diligence. And we came across a solution called a Delaware Statutory Trust. So we were able to take her $2.5 million, do a 1031 exchange into a Delaware Statutory Trust, avoid paying the $800,000 in taxes. She had the whole $2.5 million working for her. And of course, the income was over $120,000 a year, and she was very happy. As soon as we did that, we went to lunch, and it was the first time in my life that I'd ever had hugs and kisses from a client saying, "This is the greatest thing you've ever done." And the real estate agent said, "This is the greatest thing you've ever done." And since then, we've had 10 referrals from that real estate agent alone because they see the power of what it did. And I remember turning to my son saying, "We need to do this 1,000 times." And since then, we've done it over 1,000. So that's our story. Okay.
I love it. That's awesome. And I think it's great. I mean, you helped that widow, when she probably was going through a tough time, didn't have much guidance. She was, worried about the implications of selling her property. It's really awesome story. I love it.
It was great. I mean, it really opened our eyes is what happened.
Carlos, what are some of the other exit planning solutions, the 1031 Delaware Statutory Trust, that Sera Capital offers to clients?
Well, we've been doing this a long time now. So we started out just doing the Delaware Statutory Trust. What ended up happening is, we get a call from somebody saying, "Yeah, I don't want to do that, but I don't want to pay taxes." And I'd say, "Well, I can't help you. Sorry, can't help you." And after this happened about 30 or 40 times, I said, "Well, if you find something, let me know." And eventually somebody calls me up and says, Hey, we're going to do a deferred sales trust. I go, what is that? So after we heard that about 30 or 40 times, we said, we better investigate. We'd be negligent if we don't know what this is. So we investigated it. We found out about the estate planning team. Did a whole due diligence. And that's how we ended up somewhat with you here today, because we do offer that mostly, by the way, for our clients selling businesses. They come to us, they're not necessarily our clients. They come to us either referred from other advisors, or they come, they come to us directly, or mostly they come because the typical, let's say dentist who's selling the dental practice that owns the real estate. Well, they want to come up with, they can't 1031 the practice. They don't want to pay taxes on it. What do we do for that? So we'll do the real estate, we'll do the 1031s into the DSTs, and then the practice, we would suggest the deferred sales trust. We might even suggest the qualified opportunity zone funds. Those are basically the top two solutions for that. Unfortunately, you can't defer it and eliminate that tax
Right.
like you can in real estate.
I wish we could say that you could just eliminate, avoid, defer. It's just a deferral. But no, that's great. So you mentioned opportunity zones as well. Would you mind talking a little bit about how the opportunity zones are helping your clients?
Well, let's say you're selling a business that a dental practice for $1 million, and your cost basis is $300,000. The legislation for opportunity zone funds only requires you to invest the $700,000. So the $300,000 you can put in your pocket. And the reason is the government wants to incentivize people to not take, basically what happens is the government wants to incentivize you to sell the practice, okay, or sell the highly appreciated shares of Apple stock and whatnot. Because what we find is that people will hold on to investments longer than they should, because there's a tax implication behind it. And so the QOZ legislation was formed in 2017, so it's only 6 years old, encourages people to sell and take the 700,000 and invest it. And then what you do with the 700,000 is there's a lot of great benefits with it that are somewhat boring, but essentially you defer taxes, and then after a 10-year hold, you eliminate 100% of the capital gain with it. So on that $700,000 investment that you make in 2023, the tax that you would pay this year, you still got to pay in 2027. But if you leave the money in the investment in 2033, 10 years from now, let's say that 700,000 is worth 2 million, you get the entire 2 million out tax-free. And it's great for a lot of real estate investors as well, because they can take that 2 million and put it in the stock market or whatever. Or it's great. So we have some clients that are selling highly appreciated, it's amazing how many people out there are worth millions of dollars in one stock and have zero real estate. So they'll buy a qualified opportunity zone fund, and 10 years from now, they can move it out of that stock, and during that 10-year period, they own real estate. So, to us, qualified opportunity zone funds are shapeshifters. They can move real estate into equities after 10 years, or equities into real estate immediately. That's how we use them. That's how we explain them.
Wow, it's a really good way to explain it. I've heard a lot about opportunity zones. I don't think I've heard it explained that way, as like a shapeshifter from, a highly appreciated asset into something like real estate.
Yeah. A lot of people, Silicon Valley is the poster child of qualified opportunity zone funds. They love them.
Well, Carlos, you guys get so many calls every day, right? What is the mindset that you guys use in your office to determine what's going to be the best fit for a client when they call you?
There's about 10 different profiles. So you think of, the latest buzzword now is artificial intelligence. Well, I take every first call with every client, no matter what. So I call it Carlos intelligence. Okay. I pretty much know within the first 10 minutes of a conversation which way somebody should go. Okay. I would say 90% of our leads are coming for people that are selling highly appreciated real estate, and they have a real estate mindset. They want to stay in real estate. It's that simple. So it's just very simple, a 1031 exchange. And then it's just the question of, do they want to buy a traditional DST? Do they have debt in the real estate they're selling? Do they want to buy a DST that converts into a REIT? We know all the situations that take place. Is it a father-son team or a father-daughter team or a mother-son team? I just got a call this morning from 4 siblings that have $6 million worth of real estate, and they're in their 70s, and now they're planning for the next generation. There's 22 beneficiaries out of them, and they go, we're not going to let them have this real estate. We got to figure a way to exit plan. So we're going to sell the real estate. We're going to put it eventually in a REIT, and all 22 of the beneficiaries will be able to go their separate ways with it. Stuff like that. So, and the beautiful thing is they'll get a step up in basis. So
that's great.
Yeah, their kids will get it tax-free.
So as someone you're kind of at the forefront, right, of so many real estate transactions. I mean, every time I talk to you, I think you say you've got, another 10 phone calls with someone who's in real estate. So what are some of the trends you're noticing right now in Q4 of 2023?
Well, the biggest trend is that let's just say real estate sales are down dramatically. Purchasers of real estate are using cash, and people that are in the real estate, I got a call yesterday, a gentleman selling a property for $450,000. He's got 270,000 of debt. So his loan to value is almost 60%. And he's looking at what he can buy with it. And he's saying, I'm going to be negative cash flow. There's nothing I can do because the loan I got to get is going to be at, 8 or 9%. So what we're seeing is that person is coming to us, and what we're doing is, if 3 years ago, you couldn't find a zero coupon bond DST, and now everybody has the zeros out there. So what this person can do is they can put $40,000, $50,000, $60,000 into a zero coupon bond that covers their debt. Okay. And then the balance is an equity that can buy an all equity DST that 2 years from now, they can 1031 into something else, if the market changes. So we're buying them a free look, if that makes any sense. They want to sell, but they can't find replacement property. And so we're finding a solution, a tax-free solution that gives them options a couple of years down the road. So that's new.
Have you noticed that a lot of people, like you were just mentioning, instead of selling, instead of looking into DSTs, that they're just holding on to their real estate assets?
Yeah, well, you know how the real estate mindset is. My neighbor sold his property for 800,000. I listed mine for 840 because mine's better. Obviously, it's always better. My only offers came in at 740. I'm going to hold on. Okay. And over time, all the comps come down because somebody actually sells, and we need to it's a new equilibrium. So that's kind of, we're in the process of getting to that new equilibrium.
I agree. And some of the financial advisors I've spoken with in the past, I speak with, on a consistent basis. They've got clients who have already maybe sold their business, or like we were talking about a little earlier, they're looking for opportunity zones.
Yes.
If they refer a client over to you, how can we be certain that, you'll respect their client advisor relationship?
Well, it would be dumb if we didn't, because we get a lot of referrals from advisors all over the country. But we are often brought in as just short-term fixes. Okay. If most advisors have great relationships with their clients, and they didn't all of a sudden pick up a client who's selling a business and this is the first time they meet them. Okay. They've been working with them for 10, 20, 30, 40 years. Who the heck knows? This is a part of their net worth. It's not their IRAs or their pension plans or their brokerage account or anything else. So they bring us in a specialist to just find the right investment for them. It's a transaction. It's not a relationship. It's an education and a transaction. Once the transaction's done, we collect a fee and we disappear. It's just that simple. If the advisor has any questions along the way, or the client has any questions along the way, which is rare because a QOZ is a 10-year hold, but if they have any questions along the way, we'll be there to answer, and we'll make sure that we facilitate the discourse with the sponsoring firm that's actually where they actually have their money invested. And of course, the shares have an NAV, which the advisor can just put right on their custody, whatever platform they're using. So it's really pretty straightforward. Same thing with Delaware Statutory Trust. A lot of people bring us in just to do, my college roommate, one of his clients is, 69 years old with 3 wives and 3 heart attacks. He doesn't know how to do a 1031 exchange. He brings us in to do it, and then eventually, he ends up managing the custodies the assets. So we do this all the time.
I love it. And this next part, if you're a commission-driven Delaware Statutory Trust salesperson, probably you should plug your ears. You're not going to like what you're about to hear. But Carlos, fees always matter. Could
Sure.
you talk a little bit about how your clients can get the exact same Delaware Statutory Trust investment for just about half the normal cost?
Sure. So it's important to look back at the beginning when we first did our first transaction with that 77-year-old widow. Why did it take so long to figure this out? It wasn't because, it's all that it's somewhat complicated, but creating the right fee structure was imperative. So when we looked at every Delaware Statutory Trust of that period, the commission that the sales rep received was somewhere in the neighborhood of 7 to 8%. 7 to 8%, which, if you know anything about being a fiduciary, you look at that and you go, this is the most outrageous number I've ever seen in my life. I cannot believe that anyone could get paid this amount of money. Okay. But to be fair, the industry at that time was a tiny little industry. And it was all in Southern and Northern California, Northern New Jersey, and New York, which is where all the capital gains were. Because none of this works without capital gains, right? At least in real estate. So as we got into it, we realized we have to come up with a better way. And we wanted to charge our clients an ongoing fee, but our attorneys said, you can't charge an ongoing fee. You're not doing ongoing work. So you have to charge a consulting fee. So we charged a consulting fee. Then we had to figure out how much to charge. And as we went through it, we realized that the most we could charge was 3%. And so we set up a fee structure at the time, which was 3% on the first 3 million, 2% on the next 7, and then 1% thereafter. However, that 7 or 8% commission that is embedded inside of every DST, we credit it 100% to the client as additional equity. They get it. So we have no incentive to sell this DST that pays 8% versus this one that pays 7 versus this one that pays 6 versus this DST that nobody in the country is buying. So the sponsor's offering an extra 5% commission. Okay. So the client knows that they're going to pay the same whether they buy this one, this one, this one, or this one. And of course, we have access to all the same ones. I mean, DSTs are like Skippy peanut butter. You just, they're on the shelf. Why would you pay an 8% commission when you can pay 3%? And that's basically our model. It hasn't changed since we launched. And it's amazing to me that the industry still survives at full commission.
Yeah, that's really interesting. Are there other people out there that are doing the same thing as you, or is this pretty?
There's a number of people who have taken our model and run with it. And there's a number of brokers, by the way, that have said, we really like this model, and they've set up separate RIAs, but they bring in all their marketing through their brokerage group. And then what happens is, if they can sell you the 7 or 8% commission, they do. But if you balk on fees, they move you over to their wealth management group, okay, and then compete with us. So, they're not dumb. They're not dumb. So there's, it's like they're skimming if you're dumb, If your client is dumb, you're going to pay a lot. And if you're a little bit smarter, you might get a better service.
Oh man. So
So
as a seller, I mean, what would be some of the benefits to working with Sera Capital? From experience, expertise, aside from those two things, what would be some of the really, helpful benefits?
well, fees are one, obviously.
Sure.
So no conflict of interest. Our due diligence is, I consider, far better than that of a broker. And the reason is, well, I've been doing this for over 40 years of due diligence. And let me tell you, due diligence on real estate on a scale of 1 to 10 is about a 2 compared to doing due diligence on a stock. Okay. It's not complicated. That's number one. So our due diligence is better. And as a fiduciary versus a broker, let's be clear. If you look at our competitors, they here's the menu. Here's every DST available in the United States. Which one do you want? Our job as fiduciaries is go, this DST is an appropriate solution for you, but which one? So we have to dig further than our competitors. And so we do. So there's a number of firms we will just simply not work with that provide DSTs in the marketplace because we find them conflicted. And one of the things that we have done is we pretty much, within the DST world, there's a thing called a swap till you drop approach. I don't know if you're familiar with it, but when we got started in the business, the whole concept was somebody buys a DST, they make an 8% commission, the broker. 5 years later, they sell it, they buy another one, make another 8%. And they keep swapping till they die. And then when they die, the beneficiaries get to step up in basis. Well, about 3 or 4 years ago, the major players that got into the DST space, major players, we're talking the $1 trillion players, not $10 million players, got into the space saying, how could we participate in the DST marketplace? And they created a mechanism where you can go from selling a property in California or Utah or Florida to buying a DST that lasts just 2 years, that then moves you into a REIT. And you never have to swap again. So if you're looking to making a very low fee investment, that's the way to go. And so we recommend that quite a bit. That's probably become 70 to 80% of our practice. And as a fiduciary, we're not even going to get our 3% every 5 to 6, 7 years. We're going to get it up front and never again. So we're very cognizant of the fact of trying to do what's best for the client.
That's awesome. You really don't hear that much lately, especially in the world today. Everyone's really searching for that commission.
Well, we're very happy making 3%. Because we get a lot of volume. I mean, we get, where someone's getting 8%, they may get a call a month. We're getting, multiple calls a day from people all over the country saying, an advisor came, said you should call me. A friend called me. I saw you on the internet. Blah 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 blah. So it's kind of fun. So yeah. 3% of a lot is much more than 8% of a little. We're very happy with our model, and we're waiting for the day that there's a DST firm out there that says we'll only work with fiduciaries and we're going to come out at a no commission. Hasn't happened yet, but it will.
Okay. I'll be on the lookout for it. I'll shoot you a text when that day comes. But Carlos, what does the future look like for Sera Capital?
Well, I've had offers to sell my business, obviously, over the years, but when you have your kids and your nephew in the business, that is not going to happen. So we have a great succession plan in place. My son Carl is 37 and he was named president a year and a half, almost 2 years. This January will be 2 years. So he does a much better job running the company than I do. And so that's the future. And his brother's been with us a little bit over almost 3 years now as my nephew. And so they'll be there as well. And so that's the future of Sera Capital. Hopefully we're doing this 50, 60 years down the line. Hopefully. I won't be, but someone will.
I love it. And Carlos, you're also an author. Tell us about your book, Financial Tales.
Oh my, I wasn't expecting this, Paul, but here you go. Financial Tales by Carlos Sera. I wrote that in 2015, or it came out in 2015. And it's a collection of 61 tales. There's no charts, there's no graphs, there's no tables in the book. Imagine writing a finance book that doesn't hide behind numbers. Okay. So I wrote basically 61 case studies of clients and the good, the bad, and the ugly of what they did, the good, the bad, the ugly of what I did. You know, as you were evolving in this business, you do a lot of good things and a lot of dumb things. So by 2015, I figured I'd done all the dumb things I could have done, 30 plus years in the industry. So I wrote about that, and it was extremely well received. My son helped me quite a bit, and I probably have 400 tales out there, but most of them have numbers and charts and graphs. These do not. So that's basically, it's the good, the bad, the ugly of people, what they've done with their money over the years.
Perfect. And can people, if they're interested, can they get that on Amazon?
Oh yeah. Yeah. When we first came out, we were the #1 for about 4 weeks on Amazon.
Wow, that's pretty cool.
Yeah. Yeah. And so if anybody wants one, you just call us or drop us a line. We'll give you a digital version for free, or you can buy one. And whatever we make on that, we donate. We don't really care about making money on this. This is more of a, I dedicated this to my children. And the reason is because I wrote it for them. So what can I say?
That's awesome. I love that.
Yeah.
Well, do you have any favorite books of your own other than, of course, Financial Tales?
I've read so many finance books, I can't tell you. I've read 200, 500, I don't even know. No, to me, there's no I have no favorites. I think that it's a combination of many. I have lots of stories, though, I got to tell you, because I take everyone's stuff and I kind of put it in a perspective that's unique to mine, shall I say. Not, who knows? Anyway, I will say I'm in the process of writing another book, because even though I ended up getting 5 stars on Google on this, where I would get 4 or 4.5 stars, it would always say, that's great, but what do I actually do today with my money? The how to. And I didn't want to do that. I want to write an evergreen book. That's an evergreen book. I want someone to pick this up 100 years from now and it's still relevant. But I want to write a more how to that might only be relevant for 5 years, which I can update, or my sons can update, or whatever. And so I'm in the process of writing, how to do this, which is quite frankly boring, but, necessary.
If someone right now was looking to exit, whether it's their business, their real estate, a highly appreciated asset, what is one thing that they could do today? Like you're mentioning right now, that they can take action and learn just a little bit more about their options. Obviously, I know they can give you a call, but what is something that, they should start looking out for?
Yeah. Well, I will say there's no really good books out there on that, because there's so many options and the options are always changing. So I don't want to write a book like that. I could, but I don't want to, because I don't want to update it every 1.5 or 2 years. All right. It'll be just too much work. So I would go to our website. I would read all of our blog posts. I would go to your website and read all your blog posts. And that gives you a good 95% coverage of what's out there. And then I would do a deep dive on it before I'd even go see my accountant. Okay. And then I'd go see my accountant armed with information, because 9 out of 10 times your accountant is not an expert on exit planning. Okay. And then I would be really smart about how about selling my business. Let's face it, the real value is in the fact that someone's created a business over a lifetime and how smart they sell it. And then we come in on the back end, just, we're optimizers. That's it. We're not creating the value. We didn't do anything. We're just optimizing.
Perfect. Well, Carlos, I really appreciate your time. I really appreciate you joining in. Something I do ask everyone who comes on this podcast is, what is your why, and why do you do what you do?
Oh, that's a good question. My why is because our family came from Cuba, as refugees in the 50s. And so we've been very close. And to have a family business like this, which was never the intention and was never my why, is now my why. Does that make sense?
Totally.
And
Totally.
that's it. And so, I'm 65 years old. I still come to work every day. And I plan on keeping working because this is fun.
Yeah.
Just that simple. How many people get to talk to you and talk to people all over the country every day? Okay. It's great. So
No,
is that a why?
that's super cool. And Carlos, if someone wants to reach out to you, if they want to learn a little bit more about what you do, a couple of things. One, where are you located? Maybe they're close by, they want to stop by and say
Sure.
hi, or what's the best way to reach you otherwise?
Well, we're in Annapolis, Maryland, and everybody's in Annapolis, Maryland. We're not remote. Okay, our office is in Annapolis, Maryland. We're in a physical location, so you can always come see us downtown at the marina. And you can reach us on our website, seracapital.com, and you can set up a calendar appointment. We give half-hour free appointments, every day. You'll probably get me on the phone. Okay. And after that, I don't know, but definitely on the first call, you'll get me. Okay.
Perfect. Well, Carlos, thanks so much for your time. I really appreciate you coming on. And for all the listeners, thanks so much for tuning into this episode of Tax Strategy Digest.
Thanks, Paul. It's a pleasure. Thank you. Appreciate it.